Imagine a world where your digital pounds, locked safely on your phone, can settle your grocery bill or an international transfer in seconds. No banks, no borders, no middlemen. This isn't science fiction. It's the promise of stablecoins, a new breed of digital money pegged to real-world assets like the British pound or US dollar. But as their use explodes, so do the risks. And now, the UK is about to make a move that could reshape not just its own economy, but the entire global crypto landscape. The question: will Britain's push to tightly regulate stablecoins be the breakthrough that finally tames crypto's Wild West, or a bureaucratic disaster that stifles the very innovation it hopes to attract? Let's rewind. Crypto's rise began with Bitcoin over a decade ago, dazzling the world with a vision of decentralized money. But volatility proved a cruel companion. Imagine your salary dropping 30% overnight just because Bitcoin had a bad week. Enter stablecoins, digital tokens engineered to stay steady, typically backed 1-1 by traditional assets. With names like USDT, Tether, USDC, and even UK-issued stablecoins, these tokens aim to provide reliability in a sea of crypto chaos. In theory, they promise the best of both worlds: seamless, fast, borderless payments without the whiplash of wild price swings. The appeal was immediate. Retail users, crypto traders, fintech startups, even mainstream payment networks rushed to adopt stablecoins for everything from remittances to DeFi projects, global settlements, and cross-border finance. According to Chainalysis, global stablecoin transaction volume exceeded $7 trillion in 2023 alone, almost 10 times the GDP of the UK. But as the money rushed in, so did the cracks. 2 years ago, the world watched in shock as Terra USD, one of the world's top stablecoins, collapsed nearly overnight. Investors lost billions. It was the Lehman Brothers moment for digital assets, remarked Marcus Hughes, head of regulatory affairs EMEA at Coinbase. Suddenly, the myth of bulletproof stablecoins was broken. Until that moment, the crypto industry had thrived in a regulatory gray area. The UK, keen to become a global crypto hub, mostly took a hands-off approach, watching from the sidelines while Singapore, the US, and the EU each drafted their own varied and often contradictory rules. Now London is determined to step onto the field and to lead. Earlier this year, the Financial Conduct Authority, FCA, Britain's top financial watchdog, unveiled a sweeping plan to bring both stablecoin issuers and crypto custody services under formal oversight. The headlines made waves: UK to regulate stablecoins, a new era begins. But what's actually changing, and why does it matter for everyone from high-stakes fintechs to the average person on the street? First, let's break down the core proposals. Under the FCA's draft rules, any company issuing stablecoins in the UK, or even just safeguarding crypto assets for UK clients, will soon face tough new requirements. Stablecoin issuers must hold a minimum capital of $350,000. Custodians, the firms that safeguard digital assets, will need at least $150,000. Compare this with many current players who have operated with little more than a website and a dream. The goal? Weed out fly-by-night operations before they can even start. But it goes far beyond cash reserves. The FCA wants stablecoin reserves, the money or assets backing each token, to be held with independent custodians, and crucially, in a statutory trust. That means if a stablecoin company collapses, user funds are legally protected, not sucked into bankruptcy proceedings or misused to pay off creditors. Users will gain an unconditional right to redeem their coins at face value and get their money back by the next business day. For stablecoins to serve as a reliable means of payment, users need strong protections, the FCA explained. One especially controversial twist: stablecoin issuers aren't allowed to pass along interest earned on those reserves to holders. That could mean less incentive for everyday users to hold digital pounds over old-fashioned cash or electronic bank money. The trade-off, regulators argue, is safety and trust. There's also a push for transparency. Firms must provide crystal-clear information about how reserves are managed and where they're kept. They'll need watertight disaster plans so customers can access their assets even if the underlying company fails or a scandal erupts. Think of FTX or Celsius, where customer funds simply vanished. For the first time, crypto custodians will also have to segregate client assets. No more commingling company and customer funds in a murky digital soup. All of this is driven by lessons learned the hard way. The UK saw the chaos that followed the collapse of Terra USD, FTX, and others. Billions wiped away, confidence shattered, and regulatory agencies everywhere left scrambling. "We're looking to back innovation, but not at the expense of market trust," said David Giel, the FCA's executive director for payments and digital finance. It's a sentiment echoed by Sarah Breeden, deputy governor at the Bank of England. The FCA's proposals are a solid step toward building our stablecoin regime. But there's more. Recognizing that some stablecoins could become so big they pose risks to the entire financial system, the FCA is working with the Bank of England on a parallel regime for those operating at systemic scale. If a particular stablecoin gets too big, think something on the scale of Visa or MasterCard, the Bank of England will set stricter rules, covering everything from risk management to more robust reserve requirements. The central bank's own consultation is expected to drop later this year, with industry leaders watching closely. Meanwhile, the UK government is eyeing the long game. Chancellor Rachel Reeves pledged to build a full-scale regulatory regime that would allow the UK to leapfrog other nations as a hotspot for digital asset innovation. Starting January 1, 2026, UK crypto firms will have to collect and report detailed data on every trade, every transfer. The message? London wants to be the world's crypto capital, but on its own terms. So what are the stakes? For one, these rules could finally bring the clarity that mainstream financial giants crave. Big banks, payment networks, and global fintechs have hesitated to enter crypto, wary of reputational risk and regulatory fog. With guardrails in place, the hope is that a new wave of institutional money and technology will pour into the sector, unlocking faster, cheaper, and more reliable digital payments for everyone. Yet for crypto startups and die-hard enthusiasts, the FCA's proposals land somewhere between a necessary evil and a threat to the industry's DNA. Critics warn that sky-high capital requirements and rigid rules will crush small innovators and hand the reins to banks and megacorps. Imagine a world where only the largest, most established firms can afford to play. Does that sound like open, decentralized finance? Here's the emotional catch. The UK is gambling with its future as a tech leader. Get it right, and London could become the Silicon Valley of digital finance, attracting bold founders, fresh investment, and world-beating products. Get it wrong, and regulation-heavy Britain could scare away the very visionaries who put the city on the tech map in the first place. The FCA's approach is a high-wire act, too soft, and the risks of another Terra USD or FTX loom large, too tough, and the next crypto breakthrough might just be built in Dubai, Singapore, or even Paris. Ashurst Law Firm, a top player advising financial institutions, put it bluntly. The requirement for stablecoin issuers to back tokens with high-quality liquid assets isn't just about safety, it's about confidence, in the market and in the regulator. Let's not forget the public. For most people, crypto assets remain a mystery, a tangle of jargon, hype, scams, and get-rich promises. The FCA promises clear consumer protections, but will these rules truly make stablecoins as familiar and trustworthy as the pound in your wallet? Will mainstream adoption actually follow, or will the hurdles prove too high? One underexplored twist. The FCA is mulling whether to allow overseas stablecoins into the UK payment chain, provided they meet local standards. This opens the door for global competition, but it also risks making regulation an endless arms race. If a US, EU, or Singaporean stablecoin meets UK standards, should it have the same access as a homegrown champion? Tension is already mounting. Crypto industry bodies argue that some proposals, like statutory trusts and daily redemption rights, will be costly and complex. Tech founders warn that innovation may grind to a halt, and that liquidity could shift to less regulated offshore venues. Overly restrictive regulations could drive crypto activity underground, one senior analyst at Chainalysis cautioned. On the other side, consumer advocates and traditional banks call for even tougher rules, fearing systemic risk and financial crime. The consultation period is open until August 2025, with final rules expected in 2026. In the meantime, businesses and investors are caught in limbo, unsure how to prepare, where to invest, or even if they'll be able to operate under the new regime. So, as the UK approaches its bold new experiment, the world is watching. Can Britain invent a Goldilocks model, not too soft, not too tough, that protects consumers, attracts innovators, and sets the global standard for digital money? Or will the dream of a crypto-powered city of London collapse under the weight of its own ambition? As we move into the next part of this story, we'll ask, who stands to win and lose from these historic changes? Could this regulatory shakeup actually spark the next great financial revolution? or unleash a wave of unintended consequences that nobody sees coming. Let's pick up right where we left off. The UK's bold move to formally regulate stablecoins and crypto custody isn't just about crossing T's and dotting I's, it's a seismic shift that will echo far beyond the City of London. The world's financial eyes are fixed on the British Isles, curious and cautious in equal measure, wondering, will the UK light the way for global crypto legitimacy, or will it accidentally build a wall that keeps out the very innovation it craves? To answer that, we need to explore what could happen next. The stakes? Nothing less than the shape of the global digital economy for the next decade. Let's imagine three futures, each with its own winners and losers. In the first, and the one government ministers openly court, the UK becomes a global crypto hotspot. Here, new laws bring clarity and confidence. International banks, high street retailers, and even fintech upstarts flock to London, eager to launch stablecoin-based products. Big players, think HSBC or Barclays, develop stablecoin wallets you can access through your banking app. International stablecoin issuers like Circle or Tether race to get approved, transforming the UK into the world's on-ramp for compliant crypto. Consumers finally have digital money that behaves as predictably as pounds sterling, but with the low fees and instant settlement that crypto promises. Startups, once fearful of regulatory whiplash, find a clear, fair playing field. Capital pours in. London cements itself as the Wall Street of Web3. But there's a second scenario, where the new rules go too far. Innovation is slowed by heavy compliance costs. Remember, stablecoin issuers need at least £350,000 just to get started, and custodians $150,000. Not peanuts for a fresh startup. Strict requirements around who can issue coins and how reserves are held favor big, established players who have the lawyers and the balance sheets to cope. Small UK firms are squeezed out. Some even go offshore or underground, finding the regulatory maze too complex. The truly innovative projects, the next Revolut, the next groundbreaking DeFi protocol, move to friendlier jurisdictions. The UK's crypto landscape becomes a gated community, safe but sterile. Global crypto talent takes its laptop and ideas to Berlin, Dubai, or Singapore. London's bold bet fizzles. A third possibility is something messier and less predictable. What if regulations are just tight enough to keep out the bad actors but flexible enough to let smart risk-takers thrive? The UK becomes a proving ground for compliant innovation. Here, regulation isn't an obstacle, it's a moat. International institutions see the UK's green checkmark as the gold standard. US and EU regulators look to London's experiment, adjusting their own rules in response. Stablecoins, once the Wild West, become as boring and as powerful as regular money. And retail users, they barely notice, except that their transactions are smoother, their money safer, and hacks less common. David Giel, the FCA's executive director for payments and digital finance, summed up this vision saying, "We're looking to back innovation, but not at the expense of market trust." His words aren't just a soundbite, they're a razor-thin tightrope. But let's not gloss over the risks. If the UK's rules are too complex or costly, we may see the emergence of two parallel crypto markets, a regulated one, dominated by banks and legacy finance, and an unregulated shadow market, where smaller players and high-risk bets flourish out of sight. That could undermine everything the FCA hopes to achieve: user safety, transparency, and mainstream adoption. On the global stage, the outcome of the UK's regulatory experiment could inspire a domino effect. The EU's MiCA regime is rolling out comprehensive crypto rules. Singapore has already established itself as a crypto-friendly hub. The US remains divided and slow-moving. If the UK's approach balances innovation and safety successfully, other countries will likely copy key features, accelerating global harmonization. If it fails, the UK could find itself isolated, watching as rivals capture the next wave of financial innovation. For the world's financial system, the consequences are profound. Widespread adoption of stablecoins, especially those fully backed and tightly regulated, could transform not just payments, but how international trade, remittances, and even banking function. Imagine a world where pounds, euros, and dollars flow instantly, 24/7, with the transparency and programmability of blockchain, minus the risks and speculation that haunt crypto headlines. But such a world also brings new headaches. Central banks and regulators would need oversight tools for a digital, borderless economy. The FCA, Bank of England, and HM Treasury must coordinate closely or risk creating regulatory blind spots. If the UK's new rules work, the country could wield outsized influence in the global crypto conversation, setting standards, clearing paths for cross-border payments, and capturing a new generation of financial innovation. Or, as some skeptics warn, heavy-handedness could push the next wave of crypto breakthroughs. Think AI-powered payments or decentralized finance for the masses, somewhere far from London's reach. So what does all this mean for you, the viewer? Whether you're a crypto investor, startup founder, or simply curious about your digital wallet, the UK's rules could change how you interact with money itself. Let's start with everyday users. The new regime means that, in theory, your crypto held with a regulated UK custodian will be as protected as your bank deposit. You'll have a legal right to redeem stablecoins at face value the next business day. No more waking up to find your digital pounds vaporized in an overnight exchange collapse. Transparency rules will make it easier to check whether an issuer's reserves really exist, a huge step after infamous scandals like Terra USD's collapse. For businesses, especially fintech startups, the picture is mixed. On one hand, clear rules may finally allow them to partner with banks, access payment rails, and develop mainstream products. On the other hand, the capital requirements and legal complexity will raise the bar for entry. If you're planning to launch a stablecoin or wallet in the UK, you'll need deep pockets or trusted backers. Still, for those who clear the bar, trust in UK-regulated products could become a major selling point, both at home and globally. For investors, it's time to rethink strategy. Regulated stablecoins are likely to become far more mainstream, perhaps used by banks, payment processors, and ordinary consumers. This could drive higher adoption and stability, but could also mean less of the wild price swings that made early crypto investing so lucrative. Safer, perhaps, but maybe less exciting. At the same time, institutional money could flow in, turbocharging the sector's growth. If you're a developer or founder, the UK's sandbox approach, where regulators work with startups to pilot new models, could be a blessing. The FCA has signaled it will add stablecoin support to its innovation programs. This is your chance to shape the rules, submit feedback during the open consultation, and help design the future of digital cash. And for skeptics, those who worry about big banks controlling innovation or privacy risks creeping in, this period is a unique opportunity to speak out. The FCA's consultation runs until August 2025. The conversation isn't closed. If you think the balance is off, now's the time to say so. So let's return to our original question. Will the UK's regulatory gamble make it a crypto powerhouse, or drive away the very energy and talent it hopes to attract? The truth is, the answer isn't set in stone. The UK now stands at a crossroads. Its rules are some of the first in the world to blend consumer protection with open doors for innovation. But the real test will come in the years ahead, as startups adapt, institutions decide whether to commit, and other nations watch, eager to see what works and what doesn't. If the UK can walk the line, tight enough to keep out fraud and chaos, but loose enough to let new ideas breathe, it could set a global standard. It could make London the beating heart of the next financial revolution. But if it overreaches, it risks becoming another cautionary tale, proof that the best intentions can stifle the very thing they aim to nurture. Here's a secret fact you might not know. Even as the UK aims to attract the world's stablecoin issuers, its rules are deliberately designed to shut out so-called yield-bearing stablecoins, those that pass through interest or returns to holders. The goal? To block the kind of risky, quasi-banking products that led to spectacular meltdowns in other markets. It's a controversial move, limiting profit for some users, but it's a clear signal. The UK is betting on safety and trust, not hype and speculation. So, whether you live in the UK or not, keep your eyes on what happens next. Take this moment to learn, participate, and plan ahead. For startups, now's the time to engage with regulators, shape the rules, and build products fit for a new era. For users, demand transparency and accountability. These new protections are for you. What do you think? Will London become the Silicon Valley of stablecoins, or has it already gone too far? Don't forget to share your thoughts in the comments, like this video, and subscribe for more in-depth looks at the future of money.